As you've no doubt read in the newspapers and heard on the news, the major culprit in the current market volatility is Europe. And we've heard a lot about Greece and Italy, Spain, and so on. The issue really comes down to fiscal responsibility. And if I break it down into our terms, it's about budgeting 101. And simply put, if you spend more than you earn for long enough, you're going to get yourself into trouble. And that's basically what's happened. And these guys are really good at it. They've been working at it for decades. And this isn't just something that's happened recently. Particularly Greece and Italy and Spain have worked deficits for many years. And in fact, Greece had a loan equivalent to 100% of their GDP back in 2001 when they joined the EU. Now it's 150%. So the issues are that something had to give and something has to be done to fix this problem. There's been rumours, or it's been suggested that there's some possibility that Greece might defect from the EU, or the EU might throw them out. Absolute nonsense. It's just not going to happen. The EU membership to Greece is vitally important. There's all sorts of free trade, cross-border arrangements, immigration, financial, all sorts of stuff. So there's no way that Greece can afford to leave the EU, nor can Italy, nor would they want to. And likewise, the EU doesn't want to get rid of them, so they're doing all they need to do to bring these countries back into order. So a couple of weeks ago, we saw that there was complete agreement by all EU countries that they would commit themselves to underwrite effectively any member that got into financial trouble. At that time, when that occurred, the market flew up about 15% in 2 days. And I think that's an important message to us, because what the market's waiting for is some certainty. It's waiting for some closure on these issues. Everyone knows that the issues with Greece and Italy and Europe in general are going to take a long time to sort out. But what we need to see are agreements and sanctions in place that will allow them to sort them out. Since then, the EU have put together their financial package, and basically, in respect to Greece, it entails effectively a 50% write-off of their debt. And so the European Union had to negotiate with the private sector, and particularly the banks, for those investors to take that loss. And that was the agreement that they reached. And as recently as last night, we saw some write-offs of Greek bonds by some of the major European banks. The other side of that deal is that the EU is going to recapitalise the banks. So this brings about the issue that the banks will be looked after. Greece will be able to reduce their debt and so to a manageable level. And they in turn have had to agree to introduce new legislation, increased taxation, reduced spending, more fiscal responsibility to ensure that they've got the ability to repay debt over time. That's all happening as we speak. And the other latest sort of bit of news is that the Greek government have reached an arrangement where Papandreou will step out, and a unity government will be formed, which will be committed to implementing all of the issues involved in this bailout package. So just quickly moving on to Italy. Italy should be put in context. Italy is the 8th biggest economy in the world. It's a big economy, and they have the capacity to manage their issues. The problem is that they've been sending out all these messages, all the wrong messages to the market, and when the market gets spooked, they'll increase interest rates. So Italy's getting to the point now where they're almost paying 7% on their debt, which if it gets much higher than that, they can't afford it. So they've now resolved that they will commit themselves to deal with these issues, introduce legislation that will enable them to manage their debt, and they'll get rid of Silvio, or whatever his name is. Berlusconi, yeah, that's right. Yeah, and good riddance, don't we all say? So look, it's not as bad as you might think. And the good part of all of this is that they're negotiating outcomes and likely to happen in the very near future. So that's good news. And what that'll do is give certainty to the market, and the market will respond accordingly. If we move over to the US doesn't have a problem. It's got a huge debt, but it's also got a massive economy. And we should remember that the US is the biggest economy in the world, has a GDP of $15.1 trillion. And we talk about China a lot, but China's GDP is $5.7 trillion. So whilst China's an emerging economy, it's nowhere near as big as America is yet. They're more than capable of being able to handle their debt. All they need to do is increase their taxes because they're the fourth lowest tax country in the world. The problem they've got is that almost just on a year from now, there's a presidential election, and there's no way that the Republicans are going to make it easy for Obama to look good. So this political thing is going to play out over the next 12 months at least. But I think from what we see and what we hear, the markets have basically said, okay, we can live with that. They've made arrangements to increase their credit limits and so on. So America really isn't a big issue, and they're starting to show positive growth. If we look at Australia, the reality is that Australia is in an excellent position. We have little debt. We have a booming economy, believe it or not. We're growing at the rate of 4.5% as we speak. Low unemployment. The domestic savings, it's currently sitting at $1.5 trillion, which means that the citizens of Australia are saving a lot of money. So there's a lot of people sitting on the sidelines, not willing to do anything because of all of this uncertainty that's surrounding us. And no doubt this isn't helped by the squabbling in Parliament and a minority government, and I guess that's not going to go away for some time. But as all of these other things work out, we're going to see increased certainty. Lowering of interest rates will certainly help to do that and increase the retail sector and so on. So we see the signals being, we're coming out of this, we're at the end of it, we're not at the start. It's not really GFC related. The issues in Europe are much, much longer winded than that. So we really see the future as being very positive. We think that there will still be volatility for a while as these things work their way through. But from a on-the-ground investment point of view, I read a report today from a broking house that basically said, let me paraphrase, I can't remember exactly what it said, but basically it said if you're sitting there looking over your shoulder at Europe and waiting before you get into the market, you've just missed one of the best opportunities you'll ever have. And that's backed up by the fundamentals of investment. Investment always come back to their fundamental values. And if you can buy bank stocks that are paying 9 and 10% dividends, that ain't going to last, just can't last. And there's no threat to bank profitability. And that's just an example, and there's a lot more examples than that. So we've been fully invested and we're rebalancing, and we're pretty comfortable with that position. I think our clients are well poised to take advantage of market recovery, which will inevitably come. So that's our take on the economic situation and what we believe will happen to the markets. You may have read that there's a couple of important pieces of legislation in respect to financial advice. One's called the Future of Financial Advice Bill, and it deals with the provision of, it deals with us, with our profession and the advice that we give. And the major issues that are included in that bill are the ban of commissions, the ban of product commissions, the ban of training commissions, the ban on conflicts of interest, introduction of fiduciary responsibility, which means that that advisors must put their clients' interests ahead of their own. A ban on all sorts of kickbacks, administration platform kickbacks, and all sorts of stuff. From where we sit, we've been campaigning on this for a long, long time. So we're really, really pleased to see this being put in black letter law, and certainly it'll do a lot to give the investing public a lot more confidence in the advice that they receive. I suppose the downside from our point of view is that it's breaking the business model of a lot of independent advisors, which means that they'll sell out, and a lot have sold out, and a lot of large independents have sold out to institutional organisations. We don't subscribe to the institutionalisation of financial advice, and we think it's probably a retrograde step that a lot of independents are disappearing. The other piece of legislation is the Simple Super legislation. which is making changes to superannuation, the introduction of My Super, which is a default low-fee SGC fund, which again we support that move, and most of it's about the professionalism of audit and administration and education standards, which again we support. The thing we don't support is the introduction of a ban to SMSF trustees. They'll no longer be able to transfer assets in specie in lieu of cash, which we think is an absolute absurd move. And it's specific, the ban is specific to SMSF trustees. So there's clearly some political playing going on here, and we're certainly lobbying as hard as we can to try and get that part of the legislation removed. Now, just before I sit down, I'd like just to touch very quickly on superannuation and just what superannuation is. And we read a lot in the papers about superannuation not performing or superannuation not being a worthwhile investment and so on and so forth. The reality is that superannuation is not an investment. It's nothing but a tax structure. So that investments inside superannuation versus investments outside superannuation, the superannuation investments are always going to be better off because they don't pay as much tax. And that's why we use superannuation and all of the things that my colleagues are going to talk about tonight. So it's really about the skill of the investment. It's about how the investments are managed. It's got nothing to do with superannuation as a structure. So I just wanted to sort of clarify that point.